Hello everyone and welcome back to Common Sense Crypto channel. As with you always, this is Rich doing another video today. So I hope you're all having a wonderful day today wherever you are in this great world. We're going to talk a lot about stablecoins and regulations in this video. So let's take a look. Crypto traders panic sell $4.7 billion USDC for fiat on Coinbase. Coinbase has burned $4.7 billion in USDC, converting the stablecoin to fiat in response to the actions of U.S. regulators. Right now, everybody's worried about USDC after what happened with BUSD. Lots of FUD about USDC right now. Keep in mind, BNY Mellon is their custodian. BlackRock manages reserves. Visa settles transactions in USDC. 100% backed by cash and treasuries. Audit by Deloitte. Annual audits filed with SEC. I think the FUD is overblown. I think so as well. I believe they're going to push out BUSD and Binance, and they're going to also go after Tether at some point as well, leaving the only one standing, which is going to be USDC. SEC going to come after all stables. USDC backed by BlackRock. BlackRock backs literally everything. USA wants a CBDC. USDC easily could be adopted as the CBDC and have full government oversight, while BlackRock profits as the only allowed stablecoin. We are far from over on the FUD, and possibly a massive black swan event could arise from this as well. The pace of new rules, guidance, legislation, hearings has been relentless in 2023. The most surprising of the developments is the aggressiveness of the federal banking regulators, who seem keen on making crypto companies single for 2023 in terms of their banking relationships. I think the problem with the banks is this: they want to stay relevant and they want to continue making money. They're using politicians as pawns to push certain regulations. And the politicians are behind. So they're leaving it up to the SEC to go out there and take control of crypto. That's exactly what Gary's trying to do. Last week's final rule published by the Fed is one making a lot of noise in D.C. The February 7th letter reads as a breakup text rather than a policy statement. Not only does it ban state member banks from crypto activities, but also restricts stablecoin issuance and more. And the Fed, again, is trying to do the same thing, stay relevant. Back in 2021, when the Presidential Working Group released its guidance principles on stablecoins, the regulators said they would act if Congress didn't. We are now seeing that come in full force as the bipartisan stablecoin bills failed to get finalized in 2022. That's exactly what's going on because Congress didn't act fast enough. Gary's taking control of crypto, and he's not doing it in a good way. He's, instead of trying to work with these crypto companies, he's just out there trying to shake every single one of them down right now. Look at all the money that the SEC has brought in fines in the last year. This isn't the only area stablecoins are experiencing heightened scrutiny in absence of legislation. The SEC has said BUSD is a money market fund security, but the CFTC argues UST is a commodity. This love triangle is causing a lot of confusion for the crypto ecosystem. So with the lack of regulations, none of these companies know which way to turn. It's all confusion right now inside of crypto. And some are panicking as well. Then there's the staking enforcement action against U.S. company Kraken by the SEC. Since the debacle only ended in a settlement, many crypto firms who offer staking services are now having the "so what are we gonna do" chat with their legal teams. And again, staking may go down all throughout in crypto because nobody knows what to do around staking either. There's no clear laws moving forward. The need for legislation in the stablecoin space is critical now more than ever. Unfortunately, it will be some time to get a bill across the finish line. Congress just restarted, so every bill needs to get reintroduced and go through the legislative process, which takes time. It's the same thing, like I said, about a CBDC. Everybody wants privacy laws ahead of a CBDC rolling out, but because Congress moves so slow and technology is moving so fast that CBDC will come about before privacy laws are put in place. The House is further along in those talks and has buy-in from the Dems and Republicans and the White House. Still, the bill couldn't get finalized in 2022. This will be the theme of 2023. For any piece of legislation, you need a lot of bipartisan support, political capital, and regulator love. With that, expect more regulatory actions over the coming weeks. Congress has the ability to conduct rigorous oversight of these regulators and challenge rules proposed in a variety of methods. The good news, scrutiny of the regulators is both bipartisan and bicameral. That's why we see some of these politicians saying they want to look into Gary Gensler. They want to know what he was doing with Sam Bankman-Fried, what those meetings were about, what the phone calls were about. But again, everything is moving at a snail's pace. Tomorrow's Senate banking hearing will be much more substantive than the December one with the celebrities, and that is by design. Detractors will likely endorse the divorce of crypto from financial institutions, while supporters of crypto will be quick to attack the Fed and the SEC. Other things to monitor will be the Wednesday IRS confirmation hearing in Senate Finance and SEC amendments to the Investment Advisors Act around the issues of custody. Both of these events could have a significant impact on crypto policy going forward. We're going to talk about that in this video. For now, it seems as if all things will get worse before they get better, in absence of legislation. This will fall to the courts for years. Education still continues, though with the hopes that crypto will find love in a hopeless place. You know, we need people to keep us in crypto. When regulations come out, it has to protect the retail investor, but allow us to continue investing at the same time. Rule change proposal from SEC targeting crypto companies. Now, this actually could work. So, according to new regulation, advisors will be obligated to keep their clients' funds separate from their own funds. Gensler explained that the new regulation will expand the current requirement for advisors and qualified custodians to separate funds and securities to cover all assets. That was the problem with FTX. Sam Bankman-Fried was using customer funds to go out and buy property and have a wonderful time down there in the Bahamas. If there's laws put in place where when you invest and your money is paid out to an exchange and that exchange has to keep your money separate from theirs, that could actually work out. Think about it. If the company goes bankrupt, maybe your funds will still be safe then. Gensler also warned that due to the nature of the way investment advisors work, they cannot always trust cryptocurrency platforms as custodians. In other words, Gary's saying don't trust the exchanges. An SEC official said that some investment advisors trust crypto platforms as custodians. The rule will also require a written agreement between consultants and authorized custodians to ensure clients are protected. That was about the only good thing I have heard Gary say in this whole year so far. The rest of the time, he's going to take crypto down. But we do have to have protection as retail investors. A lot of people don't understand that the exchanges are not a safe place to keep your crypto still. I see people say it all the time. You know, what should I do with my crypto? I'm still holding it over on Coinbase. I'm holding it over on Uphold. No exchange is 100% safe. You don't know what goes on behind closed doors. Elizabeth Warren and conservatives aim to take on the crypto space. And we see here. So the previous year saw crypto emerge as the best alternative in the financial system. The phase lasted until the collapse of FTX. So you like how they always bring in FTX? Withholding funds from several customers by halting the withdrawal process. Things are about to get tricky now that Elizabeth Warren has come out to build an anti-crypto army with the support of conservatives. This lady wants me and you out of crypto, period. I don't care how she tries to spin it. She wants to regulate us out. And she's, again, the focus is on national security and strengthening anti-money laundering. Centralized exchange platforms are already adhering to the concept of customer verification. Other platforms should not be afraid to implement mandatory customer verification. She wants to be able to look at the exchange and say, okay, who's holding crypto? I think this could get dangerous. It's like on a razor's edge almost. On one hand, she wants them to verify who's buying crypto. On the other hand, who's to say she doesn't watch every single crypto investment being made so she could collect those tax dollars like she wanted to do with that framework that she came out with at the end of last year? I just don't trust this lady, period. Crypto investors face paying taxes on frozen assets. Like I said, they're worried about that tax money. U.S. tax laws require citizens to pay income tax on any interest earned from corporate bonds, bank accounts, certificates of deposit, or other financial instruments, including crypto investments. Taxpayers pay income tax for the year the interest is generated. Unfortunately, many crypto investors have their funds frozen on platforms that went bankrupt in last year's hard-hitting crypto winter. For instance, Celsius Digital halted all customer withdrawals in June of 2022 due to extreme market conditions. At the time, the crypto lender managed more than $11 billion of customer assets. Celsius locked up the assets as part of a long-winded bankruptcy case whose end and outcome are yet unknown. U.S. citizens must complete their federal income tax returns by April 18th of this year and are expected to give details of all their income for the past year. The income tax rate between 10 and 37%, depending on where a person falls in the income bracket. So they want you to pay taxes on crypto that's still locked up, that you have no access to either. So, say for instance, you have crypto with Celsius. You can't gain access to it, but yet you still have to come up with the cash to pay the taxes on it. I think that's absurd, honestly. I do, because nobody knows what the outcome is going to be. Are you going to get your crypto back? Are you going to make money off of that crypto in the future? Nobody knows yet, because nobody knows what the outcome is. Again, is the Biden administration behind the attack on crypto? The attack on crypto projects is sanctioned from the very top of the Biden administration. A source who didn't want to be named has said, talking to crypto podcaster Tony Edwards hosting Thinking Crypto, the source said the operation codenamed Chokepoint 2.0 expressly targets cryptocurrency projects, most of which are rooted in the United States and continue to offer citizens access to various products. The source, who previously worked in the government before branching out to crypto, said leaders approved the crypto attack in effect in the United States. The negative attitude from the Biden administration stems from, among others, Janet Yellen, the Secretary of the Treasury, who is known to be against crypto and Bitcoin, and Gary Gensler, the head of the Securities and Exchange Commission. This is what I'm telling you. They want me and you out of crypto, period. And it's coming all the way from the top down. Whales and big traders know in coming days DXY headed to $96. So far, crypto is lagging behind stocks because of crypto fraud, Blackswan events. So crypto is catching up the speed. It's headed down to 96 cents. Sorry about that. And you got to keep an eye on the DXY. I tell you all the time, if there's one chart to watch, is that. Because once the US dollar falls in value, crypto and the stock market will take off. And the further the DXY falls, the higher crypto will go. It's happened before in every single bull run, and it's gonna happen again. The problem is, once the dollar starts falling this time, I think it's going to continue to plummet because the petrodollar is dying. If Saudi Arabia joins the BRICS, which they're planning to do, that's the end of the US dollar, in my opinion. And I think that's fast tracking everything as well. It's fast tracking CBDCs. It's fast tracking the way crypto regulations are going to start rolling out in other countries. Maybe not in the US, but everywhere else. We see it happening in the EU. I'm going to do another video today where I talk about cashless society and where we're headed with that and how fast that's amping up also. Because I don't think 2030 is the year anymore. I think 2025 looks more like the year things are going to get crazy for XRP holders, meaning that the price of XRP can absolutely skyrocket from anywhere starting now with the case ending. And I believe it's going to be an uphill all the way up until 2025. You got to also remember ISO goes live in there as well. Plus Fed now. Everything looks good for investors. It doesn't look so good for the current financial system because I think it's going to go down at some point. Everything is pointing in that direction. All the facts are pointing towards that. Look at the debt in the US. That gives you a good look at where the US dollar is going to go. But with that said, I'm going to wrap up this video. I want to thank you all for watching. I appreciate all of you watching my videos. We'll see you in the next one. Have a great night.